From our Stars and Dogs segment, it's time for this week's Dog.
Dog of the week. We're going to start with Maple Leaf Foods here. They are a food packaging and processing company. They offer prepared meats, ready to cook, ready to serve meals. Brands include Maple Leaf, Schneider's, Greenfield, along with many others. So this is a $2.8 billion market cap company, trades for about $22. They're based in Mississauga, but they own 29 processing facilities across Canada. Just last week on Wednesday, the stock released its Q2 results. Price was down 17% after the release of the results. So were these results so bad? Well, let's take a look. Revenue up 3.1%. Operating margin down 60% from 5% last year to 2% this year. So right away, as we see a major decline in operating margins, but also just a really low margin, almost break even at 2%. And then adjusted earnings per share, nil for the quarter compared to 29 cents last year. So yeah, I would say at face value, these results were really horrendous. Looking at some additional financial stats, 3-year growth rate of 8.7% per year. Now that growth rate has declined recently. Net debt to EBITDA multiple of about 4 times, a little over 4 times. I would say that that's slightly leveraged balance sheet. Now this is a manufacturing company. It's a very capital intensive industry. We would expect them to have debt, but still 4 times net debt to EBITDA. That's on the high side for me. And then price to earnings 44 times. So I would consider this expensive, particularly when looking at the state of the company's financial performance. Now, what I would normally do looking at these numbers is I would just disregard this company completely. However, if you look at analyst estimates, analysts are actually expecting a lot of growth, a little bit of growth this year, but $1.11 in earnings from 103 last year. But earnings doubling in 2023 based on analyst estimates. Now, I'm going to tell you, I would not trust these estimates as far as I can throw them. Do not depend on analyst estimates. But it's at least worth looking into, why do analysts believe there's going to be such a big increase in earnings per share next year? Well, I did a little bit of looking around, and the company is making some investments into its operations. One of the things that it's doing is it's building a new plant in London, Ontario. And once this plant is fully operational, which would actually be the end of 2023, it's expected to generate about $100 million annually in adjusted EBITDA. So that's about a quarter's worth of EBITDA. So there is some growth potentially on the horizon for this company. But you'd really have to dig in deeply to find out if analysts' projections are just basically ridiculous or if there's maybe something there. So what's the conclusion on Maple Leaf Foods, Dog of the Week? The fundamentals have really deteriorated this year, and the valuation looks expensive based on trailing earnings. We could look into the analyst estimates and see why they're expecting so much growth in 2023. But right now, we would not purchase shares of the company in its current state until we had more information.